good morning. According to ADP, everybody's got a job. So you may not be watching this right now.
Oh my goodness. That number. What was that?
I have no clue. I have no clue.
Well, I can just say the markets love.
Yeah. Did you lose your hair this morning? Oh, wait. I'm sorry.
I lost it in preparation. I actually got a head shave yesterday, and I'm thinking maybe I should have saved the money.
No kidding.
Things might get a little ugly.
Oh, a little. Oh. Yeah, I know you've looked.
I couldn't not look. When I saw that number, I was just like, and we've ended the day past some resistance lines. So I was like, man, the market, we can see a big swing on these MBS and on the bond, the 10-year, like, and boy, did we.
Yes, we did. I mean, hopping right into the numbers.
Ooh, ADP, 497 private sector job growth in June. That's like more than double what they expected, isn't it?
Yeah, it was double what they expected.
Yeah, in ADP, this report, they're just known for being super accurate. Like, they've never revised their numbers down or anything like that. Like,
no.
So I mean, the market, like, they know that this number is what it is and it's accurate. So they're going to respond lockstep. Wait, will they? Well, we know it's not accurate, but what happened?
Was this what you were talking about?
Woo!
This was before the report, 3.93, and right now we broke the 4.
Broke the 4. And here's the hard part about that. You see that it kind of looked like it was like, okay, we're going to trim back down, and it's right back. I think, don't hold me to this, but I think it's possible we go higher as the day goes on. I really think it's possible. There's just nothing that's holding it back right now.
Well, that's what I don't get is we're concentrating on one number and one number only.
Yeah.
That is it. That is it. No one's looking at anything else economically in the numbers.
Well, and you look at the thing that's funny is like everybody's tied up. The Dow down 300 plus points this morning already, right? Yeah. On this number. Wouldn't like private job sector growth typically be a good number for stocks?
Yes, I thought it's a positive.
But it's not, because what's the fear now? What do we all know that's gonna happen because of this number?
Oh, let me see. Could that be a rate increase?
Like a rate. I think everybody is expecting a rate increase. Last week, I think you said that it was possible to see 0.5%. I was like, no, we'll see a quarter. Guess what? Holy cow, I think you're right. We may see 0.5% at the end of the month.
I mean, who's the 5.1% who say they're going to hold? Who are those people?
Probably the only smart people.
Yeah. The people who, if they actually read the underlying other economic factors, are saying, no, stop it. Because heck, U.S. manufacturing slump deepens. Our index for U.S., the PMI index for manufacturing, has dropped to 46. That's the lowest recorded in history. That's
low. That's not good.
So what's it mean? It means we're not building anything.
Yeah. Well, it's because it's too costly. Inflation's too high. Got to keep bringing those rates up.
Yeah. Yeah, because we've got to push it down further. We have to destroy manufacturing further. And I mean, it was interesting because you go into the ADP numbers here.
Private sector. Let's see where we're growing.
Manufacturing lost 42,000 jobs.
Yeah. But construction's growing. So, that's a good number, right?
Yeah. Yeah. Construction's growing. But where's the other place we're growing? Well, it's not in technology.
In IT. So high wage job, not growing. Financial activity, not growing. High wage job. Growing.
Professional and business services.
Okay.
Not growing.
Education, health services, but leisure and hospitality,
32,000 new jobs.
Well, I mean, we are in the summer, which probably means those are a lot of temporary jobs.
Exactly. And are they
there are
high
a lot
paying jobs?
of definitely not high paying.
Are you going to buy a house in Orlando on a leisure and hospitality income?
I mean, maybe a month ago, maybe 2 months ago, maybe a year, 2, 3, 5 years ago. Right now, it's like with today's movement, I have to make a bunch of phone calls. And the hard part about that is a lot of them are for Disney employees that I got to call them and let them know, hey, you qualified for this much. Now you're going to qualify for this much because the rate changes.
Yep. Probably just knocked them down. What, maybe 20 grand, $25,000? Somewhere
depending on how big of a move we see. And with the trend, we're talking from Monday, we're looking at probably 0.5% worse in rates from Monday. And remember, Tuesday was a holiday. So in 2 business days, we've essentially lost close to 0.5% on interest rate for clients.
Oh my God.
We're well into the 7s now. Like we didn't just top, like last week we topped 7. Like I expect today the average rate to probably be closer to 7.25.
What did I tell you we'd be end of year?
I think you were saying 7.5, somewhere around there.
I think it was 8.
8. Wait, you said that much? No wonder why I stopped listening to you. I don't listen to this negativity.
Yeah. Oh, I'm sorry. I like math and I can add. And I mean, the fact that we added $853 billion to the deficit in the past month.
So nearly $1 trillion?
Nearly $1 trillion.
In 1 month?
In 1 month. I mean, that would cause the treasury yields to drop, right?
Yeah, you would think.
Right. Yeah. That's sarcasm, people.
We're good. We're good.
We're good.
Everything's great.
We were looking at an article in Zero Hedge.
Yeah.
And supposedly this unemployment rate is sitting, 3.5% right now.
Yeah, super. And we're growing. We've doubled the amount of private sector jobs were just added in the last month.
Just adding and adding and adding.
Unemployment numbers are like, new file claim numbers, continuing unemployment claims dropped last week. It was a small drop, but dropped, right? But what is this? 105 million working age Americans don't have a job right now. What does that mean? Like, why would the government have such a wildly different number?
Because you can't count people who aren't looking.
What this guy's reporting. Well, my curiosity, I'm just spitballing here. I'm trying to think, how does the government know if somebody's looking?
They may be getting unemployment.
So they're getting unemployment, and unemployment requires them to file that they applied for jobs, right? So they have to be looking. But if you, let's say, aren't getting unemployment, are you reporting to the government that you're looking for a job still?
No.
No, because you don't have to. There's nobody to report to, right? Like, so our numbers kind of really skewed because maybe a lot of people aged out or they've expired and exhausted all their unemployment, benefits, or they didn't qualify or they didn't do this. And now they're still looking, but.
I think it's kind of like that Fed rental increase number. Hey, this is the Fed. Did you increase your rental fee? No, but I was thinking about it. Oh, how much were you thinking about increasing it? Oh, about 8%.
That's a great number.
Yeah. Hey, are you looking for a job? Not today. I just woke up.
They call, ring, ring, click. We'll take that as they're not looking for a job.
They're not looking for a job.
They didn't answer, so they couldn't confirm they were looking for a job. So we're going to assume they're not looking for a job.
Exactly. And I think one of the questions is, well, is this really going to hurt the Orlando market? Well,
we haven't seen it lately, right?
Yeah. This is from Orlando Business Journal today. Vox, which does automotive parts.
They're like the tech, electronic components and stuff, right?
Yes, correct. Their headquarters is in Lake Nona.
Oh, okay.
And in the next 2 months, they are going to lay off 54 workers.
Then I'm a little confused. I thought automotive was like at all-time highs, this and that. Like they were MSRP and overvalue. Like, are we seeing a shift here? Like, is this starting to shift, or are they ahead of the curve? Are they behind? Like,
I think you had all those cars that needed the chips to finally be able to be sold, and then prices went crazy. I mean, how do you buy a $600,000 house and a $100,000 car?
Easy. You just got to qualify for the house. The finance guy at the dealership will make the numbers work.
We'll make the numbers work. Yeah.
He'll figure it out.
Yeah. But I mean, you feel bad because, here's 54 people, 4 initially full-time, 14 temporary workers. And then the rest are going to be laid off by 36 full-time are going to be terminated by August 31st.
Okay. That's interesting news. So these are warehouse jobs. So would this qualify like manufacturing jobs, or what would this qualify as?
I think it's manufacturing.
And probably. So
because it's assembly, that kind of stuff.
Yeah. So that's kind of that sector that we're seeing getting hit right now, which is a little concerning, right? Because manufacturing, like you see construction jobs up, but if manufacturing is down, like that could eventually have a roll into the construction side of things. Mm-hmm. Like we're starting to get to a point where the dominoes are falling, but it's almost like, I'm just going to say it. I feel like the Fed, like I almost am like, they went on vacation to Bermuda or something, because their approach is, if we can't see it, it's not happening. Right?
That they have got their blinders on, and the only number they can see is that employment number. Here's the one good thing. My house is burning down. Everything's going crazy. But you know what? The hose works.
I love it.
The hose works. So everything else is burning down around me, but guess what? The hose works.
They're in that horse race.
I can try and put out my fire with the hose.
Yep, I like it. You know what? They've got a bucket. They're probably so smart that they're filling a bucket up with the hose water, then throwing that on.
Throwing it on.
Yeah, I got you. That makes sense.
Yeah.
Excuse me. I know these guys are way smarter than me. Like I'm not playing.
I wonder sometimes, Joe.
But it's kind of weird, because it does feel like when you look at what's going on in the world and everything else, you see like Britain Prime Minister talking about inflation. They thought they were going to get their inflation numbers cut in half, and it's stagnant at like 7.7 or something. It's almost like all these countries and world powers are in a horse race right now. We're all dealing with similar crap, and they all have their blinders on. So they're only looking at one number, inflation, and they're not thinking about anything else and what it's going to do in entirety.
Yep. I mean, we didn't even hit yet today on what I initially was going to lead on till the employment numbers came out. You ready for this one? This is our commercial mortgage-backed security delinquency rate.
Well, I mean,
how long have we been talking about this?
A while. We know it's going to start jumping.
We're up to 4.5% right now.
Okay, that's not bad.
During the Great Recession, the housing never hit above 4%. This is worse than what the houses did.
Yeah.
Right now.
But, they were at like 10.5% back during the Great Recession.
Yeah, and it was so good, wasn't it?
It was fantastic.
And what's everybody doing? They're defaulting.
Well, what else do they do in commercial?
That's it. I mean, you've got people who don't want to go back to offices.
Yeah.
You've got your adjustable rate mortgage nightmare, because commercial adjusts generally, was it 6 months to every year it can adjust?
almost all commercial back is typically adjustable rate usually. And you're talking with what the Fed has done and with everything's done, these rates have skyrocketed. I mean, how many people have seen their credit cards go from a 14% interest rate to a 29, 30% interest rate?
Yeah.
Overnight, you know, within the last 6 months.
Exactly. You know, and then, there's that little story over here. U.S. national debt spiked by $851 billion. I'm sorry, I was off $2 billion.
Slacker.
So you're just sitting here and you're thinking, take the blinders off.
It's tough because I want to talk about and you know, I was having a conversation with somebody last night that was, you know, they talk a little bit about finance and everything, and they work, you know, they're, you know, a software engineer and so forth. And he's like, I want to buy below my means, and here's this, and then rates. And he's like, but I'm thinking about saving because rates aren't going to go down. I don't want to pay the high rates. And I'm talking about, well, there's low inventory. Like, what are we talking? But it got to a point where I sat there and I'm just like, man, this is kind of like, I realized that, you know, it used to be, and I say used to, like 6 months ago, I think you and I were in a consensus that, you know, a lot of people were saying rates were going down in 6 months, which would be like right now. They thought 6 months ago, start of the year, they thought rates right now would be back in the 5s. They're not.
Yeah, I need to give Barry a call.
I don't think you and I did. Like, we were saying like 12 months to 18 months. But the hard part about that is now we're 6 months down the road, and I'm still thinking 12 months to 18 months. Like, I don't feel like I should be at 6 to 12 months from where I was 6 months ago. Yeah. But we're not seeing the Feds respond the way that I thought that they would. And I just feel like we're going to see like a big, it's going to be a gut punch. And we
and it doesn't have to be. It doesn't have to be. That's the whole point. It doesn't have to be. Mm-hmm. Why does it have to be a gut punch? You know, you got them out there saying, oh, you know, soft landing, soft landing. Well, if you want a soft landing, stop the rate increases.
Yeah.
Stop it. Let everything. How many times have we said, let it play out?
What's all the data say? Like, anytime there's fiscal policy change, it takes roughly 12 months for you to see the effects of that fiscal policy change.
Exactly.
So right now,
got all these rate increases that haven't hit us yet.
Yeah.
They're really I mean, when you look at the bottom line, you know,
I think 12 months
manufacturing, from now, you know, I'm sorry, but you feel it, you know it. We've been alive long enough.
Think about when we talk about this, right? It is July. Mm-hmm. When did rates start to get out of control last year? Right? August. They started to really start to make that push up in that July-August window. They started to go up and climb at a rapid rate up until, like, you know, initially they made those changes. Rates started to go up, but they were still okay. But then August hits, July, August, and we're 12 months out.
Yeah.
Like, so we're seeing the effects of what happened a year ago on policy change are hitting us today, and we're really starting to see the ramifications. What's it going to be like another 12 months from now? You know, if the Feds decide to jump rates another 0.5% at the end of July, what's that going to do to the market? We're in new territory. We could very well be looking at Feds are going to do 0.5% at the end of July and potentially be talking about 8% rates in August.
Yep.
And I don't care what anybody says, the whole argument of, well, when I bought my first house, I was at 10% or 12% or 15%.
Yeah, and your house was $50,000.
Exactly. Like, you know, it's a much different tale. Like, it's a much, like, yes, like a car right now, I hate to say it, I have a truck. It's an okay truck, but it's just a truck, cost more than my parents' first house. Like, it's not that it's an expensive truck. It's just cost of everything is so much higher, right? Yep. So yeah, an 8% interest rate on a $500,000 home is going to hurt, right?
Oh
there's no way around that. And I think we'll see it. I think we'll see a slowdown. And I think it's going to be an abrupt, super sharp, like it will hit and the Fed will panic and we will see movement. But I feel like what we're about to hit, and I could be wrong here, is I almost feel like we're going to start teeter-tottering. I feel like the Fed's going to start playing this game of we're going to drop. We're going to raise it. Oh, we raised it too high. Now we're going to drop it. Yeah. Oh, crap. We dropped it too fast. Now we got to raise it back. And I feel like we're going to have knee-jerk reactions both ways.
What was the story? There was a story leaked today that, the Fed wasn't as unified as everyone thinks they were the last meeting.
Yeah.
Oh,
some
okay.
So they want to raise. Some people wanted one more raise. Some wanted two more raises. Like, it sounds like we're a little bit like – there's three different options floating around for what, 18 people? Like,
yeah, they're getting out there testing the waters. Okay, so if we really screw this up, we've got. We there were others who, I personally as a Fed board member felt that we should have cut or we should have stayed. It wasn't me. It's never me.
Nope, never.
It's always them. I would like to meet them someday.
I would like to meet them too.
But it's you're sitting there and it's like, take the blinders off, guys. Come on.
Yeah.
Come on. You can see what's going on.
And that's the hard part is I feel like we can see what's going on. So we know they can see it.
Yeah.
And I get that maybe they're looking at data that's pointing, maybe they see something, but I think the hard part that everybody has to understand is that the data that's being reported and shared and everything, like, it's not a complete story. Like, they can't just look at what's on the piece of paper. They got to look around them. Yeah. And I think they're so textbook right now that they're only looking at the piece of paper. It's that entire, if you can't do, you teach philosophy, right? Like, they're in the teaching mode. They're in textbook, academia world of this is what we should do based off what we're reading, right? And you got to kind of step back and go, okay, what's really going on? What can we see that's not being put on this piece of paper or the stacks of paper?
And there's a lot of it. There's a lot of stuff going on that they are not looking at all. And is it frustrating. So, all right, well, let me open this up.
Oh, we'll hit some numbers now.
Yeah. One second.
Orlando market. And it crashed. We don't even want to talk about numbers anymore.
No, it didn't crash. I just had to reopen it.
I'm just joking.
So, well, we had our end of month last month.
Okay.
And as you expect, we're going to have more closings. 617. That number is down actually about 20% from last year.
Oh, wow.
So affordability, right? Interest rate. And I actually was reading an article that Orlando now is becoming the second least affordable place to live in Florida next to Miami. Which I don't know if
I like that, but I understand it.
Yep.
It's not a lot of high wage in Orlando.
No. And then this is kind of nice to see. The single family inventory did jump up 42, even with that many sales. Okay,
that's good.
Okay, which is good. Condos really wasn't a big jump. It only went up, to 199 from 142, which you would kind of expect to be a little bit higher than that.
Yeah.
But I'm looking for a client right now, and the HOA fees have just jumped astronomical. We're looking at one for $275, and the HOA fees $570 a month.
Ooh. Yeah.
And we didn't even look at the one next door because it was a 3-bedroom, 3-bath, $710 a month for the HOA.
Wow. Well, you think about it, it's like everything that's going on with the condos and what we saw in the unfortunate tragedy in Miami, right?
Yep.
Did you ever see or did you hear about what actually caused that collapse?
No, I did not. No.
They determined that it was a leak from the pool. The pool was leaking underneath the foundation. And that ended up, and it had been going on and corrosion. And that's what created the collapse.
Oh, that's awful. Then we hop in, like we always like to look at, which is our original list and final list to the sales price. And we're starting to see this slowly
you go down a little bit,
slip back down.
Yeah.
Yep.
Which I expect a sharp drop in another few weeks.
Another few weeks. Yeah. Yeah. Mid-August. I'm expecting this to really drop maybe back down to that 93, 92%.
Everybody thought 2-1 buy downs were gone. Nope, they'll be back.
Nope. No, boy, will they be back.
Oh, yeah.
Oh, man, will they be back. I mean, your creative financing got a whole new meaning.
I mean, I almost feel like sellers should be advertising that right now. Like,
oh, yeah.
And obviously I'm not a realtor. I'm not a professional on that side. I do mortgages, but I almost feel like sellers need to be saying, hey, we'll give any buyer credit for a 2-1 buy down, right? Yep. Like you gotta show them you're willing to play ball with them to get that thing sold.
Yeah.
Especially if rates are going up.
Yep. I mean, our days on market kind of ticked down a few days, but it's still holding steady.
Mm-hmm.
Still holding steady. You know, and here you see sales price, you know, median and average, you know, just ticking along, dropped a little bit, but I'm expecting, like you said, this to come back down.
Mm-hmm.
You know, our weekly sales, you know, took the little spike for the end of the month.
Yep.
Like it always does. You know, average days on market, we've really kind of hit that leveling point.
Mm-hmm.
Again, expect this to start jumping up.
Yep.
Because of the interest rates. And we're still down nearly 16% from January 1st for inventory on the single family homes.
Mm-hmm.
And then our condos are holding pretty close. I mean, they're still holding above 98%.
Yeah.
The final list. So they're not moving quite as much. Could mean that they're priced better. People aren't trying to over exaggerate.
Yeah.
Or push that list price too much. So, you know, Orlando's still holding steady, but boy, I mean, if you look at the overall numbers compared to last year, we're down. We're down a good, 20% or more.
Yeah.
And it's just going to hold.
Yeah. And it's just going to be really interesting. Like you said, we've got July doesn't really have we're going to see. I'm curious to see what happens. The only thing that I could see potentially happening is that because everybody fears the Fed's increasing rates so much, and we're seeing such big reaction to any report, that potentially we create a self-fulfilling prophecy in essence that we worsen the market so much that the Feds don't have to increase rates.
Yep.
But they probably will anyways.
Well, they've got to the 26th. The meeting's on the 26th.
Yep.
So seeing what comes out over the next couple weeks, watching those employment numbers over the next couple weeks. I mean, we're on a average of over 250,000 new filings every week for the past, 4 to 5 weeks? So we're consistently above that 250 mark.
Yeah.
Which is nothing to write home about. And if it continues to stay above that 250 mark, do they reverse? Is what's going to be there to make that 94% jump back over to the other side of not raising rates or staying par? I don't see anything right at the moment.
No, I think we're going to kind of see the trend. I think we'll see the rates. And then I have a feeling that there's the potential for the, oh shit, what did we do to happen come first week of August?
Yeah.
I think we could see something like that. Maybe not, hopefully. I don't know. I would love to see rates start to go down. They don't even have to go down. I just like them. Like I keep on saying this, hold steady. Give me 6.5 and stay flat. Stay flat. I might be okay with 6.999. Just keep me under 7 and stay flat.
Yep.
Right. But it is like with jumping over 7, this has always been a psychological barrier in the home buying process. It has inevitably been when we see the buying halt significantly when we get over 7.
Yep.
So I'm really curious to see what that's going to look like in the coming days.
Yep, exactly. Well, we will keep an eye on it. And as always, we will be back here next Thursday to keep everyone updated. Please like and subscribe. Take care, Joe. You've got a lot of fun phone calls to make today.
Yeah, I got to make them. Have a good one, guys.
Take care, man.